It's my pleasure to welcome you to the Regulating Digital Assets virtual seminar organized by the CBER. I'm Josh White. I'm an assistant professor of finance at Vanderbilt University's Owen Graduate School of Management. I'm also a former SEC economist. All right, so the purpose of this seminar today, as we all know, the blockchain landscape continues to evolve rapidly. And so we need a deeper understanding of the regulatory space and the challenges there. It's probably never been more pressing than even over the last week. So the purpose of this seminar, what we're trying to aim to do is to provide a platform for regulators, for industry participants and academics to analyze and try to get a current understanding of the landscape and maybe future challenges. We hope to provide a thought-provoking discussion. And so I want to remind everybody that there's a Q&A function within this webinar. Commissioner Johnson's going to kick it off with a keynote in just a second. She's graciously attending from another conference, so she won't be able to stick around for Q&A, but please ask any questions. And when I introduce our panelists, they can also respond to those questions. So it is my honor and pleasure to introduce Commissioner Johnson, Kristin Johnson from the CFTC. She was appointed by President Biden and confirmed by the Senate 1 year ago, I think, last March. I'm sure it's been an exciting year. Prior to her appointment, she held endowed professorships at Emory University and Tulane University law schools. She's also a respected member of the legal community. She has worked as VP and Assistant General Counsel in the Treasury Services of a major financial institution. She holds a bachelor's degree with honors from Georgetown University and a JD from the University of Michigan Law School. So welcome, Commissioner Johnson, and we really do thank you for graciously making your time.
Good morning, Josh. Good morning to everyone on this very illustrious panel. I am excited to be here with you today. We couldn't have chosen a better moment for the conversation that will unfold over the course of the next hour and a half or so. I wish I could be with you for all of the conversation. I will do my best to listen in, even once I am away virtually, visually. I know that this is a very talented, capable group, and that their participation in the discussion will not only enrich our learning and understanding, but it will actually, I hope, influence, impact, and drive some of the thinking that we as regulators are doing in the wee hours at this point to keep up with the activity happening in markets. So ahead of my offering any very formal remarks and in light of the few minutes that we lost at the top of the hour, I will attempt to move quickly through just a few points, but ahead of sharing any of them, want to just underscore that the reflections I share are my own. They are not the perspectives or views of my fellow commissioners or the commission staff. Notwithstanding that, I think there are today is especially, or this week has been an especially significant period of activity, with comments, in fact, coming from a number of my colleagues and a fairly significant keynote address from our chair yesterday. I'd actually like to draw in my remarks on some of the comments from our sister agencies and other regulators as they're navigating real-time events. So let me just start off by sharing one observation that I have made during my time in serving as a commissioner at the CFTC, and that is that the future of finance is here. It's already here. The panel today is charged with describing the landscape for the regulatory framework existing and potential that would govern exactly how regulatory agencies like the CFTC and our sister agency, the SEC, but also increasingly how prudential regulators might think about the charges they have with respect to banking and facilitating the financing and monitoring and supervising a number of new entrants, if we could call them that, in the financial market ecosystem. I know for certain that part of your discussion today will cover the reality that the ecosystem for digital assets and for traditional finance is truly global. So if the future of finance is already here and we can observe that finance is in fact global, borderless, without frontiers, then there is a need for if not ever more than before, collaboration and coordination on the part of international regulators. The conference that I'm attending this week actually includes regulators from a number of jurisdictions around the world as we come together in formal sessions on the record and off the record in bilateral sessions. We are covering a number of the topics that you will discuss today. Top of mind for us, and I believe top of agenda for you, is navigating the challenges of regulation regulating decentralized finance and the correct understanding of how best to apply existing laws if they are fit for purpose, or to create new laws to address emerging and developing innovative financial products. I know that you will explore in great detail the definition of a security under Section 2A1 of the Securities Act of 1933, and you'll parallel that with the jurisdiction of the SEC, our sister agency. I anticipate that you'll also spend some time thinking about how the definition of commodities engulfs or ensconces the definition of securities in ways that really is intended to provide seamless protection for financial markets, comprehensive coverage, if you will. In light of the same, one thing I might point out as we move toward, we hope, legislative solutions to fill the gap that exists with respect to spot market oversight for certain digital assets that may not be securities, we are hopeful that your conversation, your discussion will evoke some clarity, some better understanding even of how we might develop that legislation and ultimately regulation that accompanies it. I know that you're thoughtful about the application of existing rules beyond merely definitions of securities and commodities as found in federal statutes. And in fact, you're moving into the application of safe harbors and conversations around the applicability of Reg A or Reg D. I anticipate and am excited to hear as you illuminate how we might think carefully about the application of securities laws in a variety of contexts as the ecosystem expands. One of the most central and significant issues that you'll focus on, that we are also focused on, is the registration question. And ahead of addressing the registration issues that you all will touch upon, let me just share a complimentary reflection, if I may, about at least one tool in our toolkit that we at the CFTC have been using rather effectively, we hope, in the context of ensuring the stability and integrity of digital asset markets. And that's the enforcement tool. While not popular, the enforcement tool has enabled us in a number of instances to essentially mitigate and to in some instances quell the uses of garden variety fraud, essentially in a number of contexts in the name of digital assets, maybe not even involving digital assets, simply marketing products as digital asset investments to vulnerable and unsuspecting investors. In many instances, the enforcement actions that we're bringing that involve digital assets all too often are not investments at all in anything whatsoever. Those who have perpetuated the fraud upon the investing public have absconded with money and misappropriated funds that were designated for investment. So as we begin to think about the tools in regulators' toolkits, I'd like to just emphasize that we at the CFTC, and we believe our cohort at the SEC, are regularly enforcing what we believe to be within the scope of our authority with respect to anti-fraud and market manipulation in the context of digital asset markets. The corollary or complementary issue that you all will discuss, which is nuanced and challenging, is this question regarding registration. It is a really critical question for us because it is part of the toolkit that we use to regulate markets, as you know well, that really enables us to have visibility into markets. It facilitates surveillance and monitoring and oversight, which, yes, better enables oversight for enforcement, but also enables us to ensure, with respect to the integrity of markets, how market participants might be engaged in a variety of activities that we can offer guidance or direction with respect to. Our ability to engage in the examination of registered market participants and to ensure their compliance with critical measures, including cybersecurity measures, is a foundational issue for us at the CFTC, and in light of the inability to require registration for certain digital asset market participants, our ability to effectively ensure compliance or to present even those regulatory standards or that framework is deeply impeded. We can point to events very recently in traditional finance markets that I discussed at length last week during a Market Risk Advisory Committee meeting. I'm the sponsor of the Market Risk Advisory Committee for the CFTC, and we spent a good part of a meeting last week, March 8th, discussing recent cyber disruptions in traditional finance markets. I highlight that notion here because one thing I would suggest is as we continue to see challenges in traditional finance markets, what we know with certainty is that they are likely to be very present even in the context of emerging or digital asset markets. There may be nuances, there may be subtleties, there may be distinctions, but it is hard to imagine that the issues that impact traditional finance markets will not ultimately likely present in the context of digital asset markets. I mention that in part because we all sit at midweek, a point that has been a week that has been very challenging, recognizing that even for the digital asset markets, there is an imperative that is part of all financing, at least in the current financial market ecosystem, that requires relying on a cornerstone set of institutions in our markets, and that is banking institutions. Here, if I may, I'd underscore something that Gerald Corrigan said January 1st, 1983. He was the former president of the Minneapolis Fed, and he asked a very critical question. As we think about the analog, or we think about parallelisms between traditional finance markets and the emerging innovative digital asset markets, one thing I underscore is that we acknowledged quite a while ago in the context of traditional finance markets that banks are quite special and play a very significant role in our domestic and the global economy. On January 1st, 1983, Gerald Corrigan wrote an essay that asked that very question: why are banks special? And in the context of the discussion, he explored that Jeffersonian Hamiltonian debate that has spanned several centuries now, and really illustrates the challenges of managing all of the complexities that can emerge in the banking system. These challenges we see this past week present themselves not only in the context of traditional finance, but will also present themselves in the context of developing markets or emerging markets or innovative financial, or the development of innovative financial products. In a number of speeches over the course of the last several months, I've highlighted the need for us to think carefully about the catastrophic costs for customers, creditors, and investors when we see disruption in the domestic and global economy. We saw in some ways disruption or contagion in the digital asset ecosystem beginning last spring. In late spring 2022, a run on the fourth largest stablecoin and 10th largest cryptocurrency, Terra USD, led to a precipitous decline in the value of UST, and in tandem, a sell-off of Luna, a companion token. A broad market sell-off and cascading losses followed. With the onset of a crypto winter, a number of highly influential and central crypto firms lunged toward bankruptcy. With significant exposure to the Terra Luna ecosystem, Three Arrows Capital, a Singapore-based crypto hedge fund, defaulted on a loan to a crypto lender, Voyager Digital. On January 1st, 2022, less than a week later, following 3AC's filing for bankruptcy, another entity, Voyager, defaulted, halting trading, refusing to permit withdrawals, disallowing withdrawals of deposits, and seeking bankruptcy protection. 8 days later, Celsius Network also filed for bankruptcy. In November, we saw FTX and BlockFi file for bankruptcy, and not long ago, the crypto lending arm of Genesis. This past week, we've seen significant disruption in the banking ecosystem, that we must be careful and cautious, and humility should be the guiding principle of the day as we imagine and explore and examine the underlying causes for the disruption that we've seen in the context of the contagion within the crypto market ecosystem, and potentially independently and separately in the context of the banking markets over the last several days, roughly the last week. We at the CFTC are deeply thoughtful, and later today anticipate releasing a statement that directly correlates to issues we see in our markets, overseeing derivatives, futures and derivatives, growing out of the events of the last week. It's been an exceptional period, and by period, I mean several years, from the pandemic and the difficulties that financial institutions faced during that time, through persistent periods of volatility and challenges with respect to margin, navigating the difficulties of markets deeply impacted by geopolitical events. We are at the helm of the ship and hopeful to steer at least the portion of the markets that we oversee carefully through these difficult waters. I invite all of you in the thinking and reflecting that you'll do today to share with us the guidance that you develop out of this dialogue and to help us as we begin to build out and future-proof financial markets. Thank you so much, Josh, for allowing me to join you today. I deeply appreciate the invitation and look forward to hearing from everyone.
Thank you, Commissioner Johnson. On behalf of everyone, I sincerely want to express our gratitude for delivering such thought-provoking remarks. Your insights and perspective are going to help us understand this topic quite a bit. I know you were really busy, so we're extremely thankful that you could make the time to deliver those remarks. So thank you again. Okay, so now, yes, thank you. Okay, so now I want to introduce our distinguished panel of speakers who's going to share their knowledge and expertise really on a wide range of legal and regulatory issues in the digital asset space. We're honored to have all of you contribute your insights and engage, as Commissioner Johnson said, in a constructive dialogue on such a critical issue. So first, let me introduce Scott Bauguess. Many of you on the webinar probably know Scott. Scott is the Vice President of Global Regulatory Policy at Coinbase, where he consults with regulatory authorities that oversee banking and financial sectors worldwide. Scott was at the SEC for 12 years, which included serving as a senior officer and deputy director of the Division of Economic and Risk Analysis, or DARA, which is the same division within. Scott supervised economic analyses of proposed rulemakings and risk assessments. He's also a member of the finance faculty at the Macomb School at UT Austin and has a teaching appointment at the University of Michigan Law School, which we will see Michigan and Berkeley are highly represented today in this panel. Scott has a BS, a master's in electrical engineering, and a PhD in finance from Arizona State. All right, next we have Zachory Massari, who's the chief legal officer and co-founder at Lightspark, which is a company that's building on the Bitcoin and lighting network. She is a fellow at the Berkeley Center for Law and Business at Berkeley Law School and an operating advisor of Bessemer Venture Partners. Zachory was previously a partner in the Financial Institutions Group at Davis Polk and a leader of the law firm's fintech and cryptocurrency practice, where she advised clients worldwide on a range of regulatory issues. So she's going to bring a wealth of worldwide regulatory knowledge. Zachory holds a BA in chemistry from Cornell and a JD from Duke Law School. All right, our third speaker is Fallon, who's partner and co-founder of Ketsal, which is a boutique law firm that focuses on the fintech space. Zach spent 9 years at the SEC, where he was senior special counsel in the Division of Corporation Finance, and he was also a staff attorney in the Office of General Counsel. Zach and I worked together along with Scott. Zach focused a lot on capital formation for small companies and exemptions from the Securities Act of 1933, as Commissioner Johnson brought up. He included, some of his work included drafting regulations such as Reg A under the Jobs Act. He previously worked at law firms in San Francisco and in London. Zach holds a bachelor's degree from Trinity College, a master's from the Guildford School of Acting, and a JD from UC's Berkeley School of Law. So welcome to you all. So I think first, we'd all really just love to hear your thoughts and responses to Commissioner Johnson's keynote speech. So, Zachory, why don't we start with you? What are some thoughts that you might have on that?
Sure. It's always a pleasure to hear Commissioner Johnson speak. I think she always has a lot of insight, both into what her own agency is doing, but also what's going on in the broader U.S. regulatory world, which is quite an active one in the past week. I think, as is true all the time for crypto topics, it seems to now be true for TradFi topics as well. Panel preparation usually goes out the window because the world changes too quickly. But I particularly appreciate the commissioner's comments about sort of the purpose, the underlying purpose of market regulation, which is obviously something that's very, very important and core to the CFTC's mission, also the SEC's mission. And I think it's worth taking a step back, as the commissioner suggested, and thinking about, why we regulate markets. And I think, from a legal perspective, right, we think about that in a couple different ways. One is that you regulate instruments based on their legal characterization. Is it a security? Is it a commodity derivative? Is it a banking product, right? And then it gets sort of slotted into regulatory categories that way. But more to the commissioner's point, I think we also need to think about why we regulate markets based on activities, right? So exchange activities, dealing activities, sales of instruments by insiders to outsiders, information disparities arising from those kinds of relationships, and sort of step away from the constant topic in crypto in particular about what are the assets, and start to think more about what are the activities involving those assets, what risks do those activities raise, and how should we regulate them? And I think that was a really important point that the commissioner made, and one that we can talk about a lot more today.
All right, great. Zach, do you or Scott have any comments that you want to make?
Sure. No, it was wonderful to hear Commissioner Johnson speak. I really enjoyed her remarks. And I guess the one thing that jumped out at me was, or a couple of things, the idea that the future of finance is here and that it's global, I think is a great point to be made. And then when you tie that in with the use of an enforcement tool to police markets and police fraud, as they rightly should, you can also look at that as the jurisdiction of a given agency here in the States anyway being more localized, right, state-based in that sense, United States, that is. And if the use of enforcement tools is wonderful, but if the financial activity can just go offshore, then you risk having a place where you're doing, playing whack-a-mole essentially, from a regulatory standpoint, or on a global scale. And that's why I think that her remarks about the need for collaboration is key, and on a global level. So that just jumped out at me as something that was well said, and recognizing sort of the tools we have, but also the work that needs to be done to kind of acknowledge that enforcement tools work, but they might be temporal in nature. I mean, they're always there, but there's a temporal nature to them while things are settling and people are getting their heads around a given industry. At some point, additional action needs to be taken, I'd say.
Yeah, thank you.
Yeah, Josh, I'll just add, she said three things that to me resonated. One is this idea of needing to be able to enforce against bad actors in markets is so true. We talk a lot about regulation by enforcement, or there's two sides of that coin. Good actors need direction and boundary conditions to know where the line is to behave, in addition to going after fraud and misconduct. And right now, I'm not sure we have that right balance in the markets, and maybe we can press in on that a little bit. I like the comment, because I used to teach this way back when, that banks are special. And what's really interesting is we're now seeing a spillover risk from fractional reserve banking into the crypto market. And heretofore we've been talking about, is crypto systemically important? Is there systemic risk? And we're seeing just the opposite right now. Maybe we can talk a little bit about that as well. And finally, she touched on the Terra Luna collapse. And one thing that I find really striking was when Terra Luna collapsed, the whole world got to watch it happen in real life. It was all on chain. We saw the deleveraging, all the total value lock dissipate from smart contracts. There was no backroom discussions amongst regulators about what was happening and should something be shut down. And so now we're seeing these discussions of which banks should have been shut down, which ones are continuing entities, again, with backroom decisions. But what a big difference between now and the global financial crisis is, we are not talking about dodgy loans that we don't understand their risks. The asset side of the bank balance sheet is really well understood. We know the risks. We know the interest rate risk associated with those liabilities. We can see what the potential losses are. So the discussions that are going on right now are much, much different than they were a decade ago. And those are all three areas I'd love to maybe press in a little bit more as we go forward.
Yeah, great. No, totally agree. All of those comments are fantastic responses. And I'll just add a couple of things. Scott, you mentioned these bank collapses of the last week. We saw USDC, which, unlike Terra Luna, which was an algorithmic stablecoin, was actually, backed by cash. but we saw it get depegged, and then simultaneously the price of Bitcoin goes up. So, taught an MBA class yesterday, and the students made what I thought was an astute observation, was that it's not like that money came out and went into fiat. They just put it right into Bitcoin, which seemed to be the safest place as a stable coin potentially collapses. And I think discussing verification of stablecoin reserves and things like that are definitely discussions I'd like to have. The other thing that Commissioner Johnson pointed out that I thought is important and probably understudied in the academic literature is this notion of vulnerable investors and who's falling victim to fraud. When I worked at the SEC, I worked in penny stock research, which is also a space that has, quite a bit of bad actors. And one of the research findings that we found as we started digging through is that when there was a market manipulation event, investors that were less sophisticated, older, retired, come from low-income areas, tended to do worse in the market manipulation. So I think trying to understand not only walking through the regulatory regime, but how do we balance that investor protection, maybe for the less sophisticated investor, but also not impede financial innovation. So that's something that I think Commissioner Johnson pointed out that we definitely need to also dig into further. So, okay, so I'm going to check, and I want to remind the participants, you can throw questions into the Q&A. I don't see any in there now, but we're going to go ahead and transition to some topics. And actually, I want to come back to you, Zahi, on this one. One of the unique factors, I think, of DeFi is that it's truly a global technology. And so could you help us just understand, much of the audience are economists and not lawyers. And even those of us that have worked at the SEC still struggle sometimes with the nuances of the regulatory landscape. So could you just describe how the regulatory landscape in the US maybe differs from other countries, and maybe how some of those differences can explain some of the things that we're seeing?
Yeah, it's a great question, and I'm going to zoom out really, really far on this one, and then slowly zoom back in, because I think a lot of where we are today in the United States in terms of crypto regulation and policy making is due to sort of the inherent structure of our financial regulatory system. So to get there, I'm going to zoom out and say a couple things about crypto in general. So I think one really interesting aspect about crypto assets is that, and we hear this a lot, right? It's not a monolith. Different crypto assets are very, very different. They're as different in terms of their economic characteristics, the legal rights that they bestow on their holders, as are, the full range of TradFi financial instruments, right? Some are like Bitcoin, issued by a truly decentralized protocol, convey no rights to the holders other than the right to hold the thing itself. Then others, like fiat-backed stablecoins, are quite different, where the holder of the token does have some right against the issuer, which is to redeem the token one-to-one for US dollars in those cases. And then you have sort of every combination and other characteristics ranging from governance tokens to all manner of other characteristics that you can observe in the market today. And so for lawyers and legal policymakers, often trying to understand how these instruments should be regulated starts with the need to classify the instruments. What are they, right? Are they securities? Are they derivatives? Are they a type of money? Like, what is this stuff? How does it fit into the existing regulatory regimes? And therefore, how can we regulate this stuff, right? Outside the United States, typically financial regulation is less fragmented and done in a less complex way than in the United States. So in a highly stylized example, you can look at the UK as an example of this. You usually have sort of one prudential regulator for banks, in particular, financial conduct authority, a financial conduct regulator that regulates markets and market activities, and then maybe an AML regime to go along with it, maybe a bank insurance regime as well. In the United States, we have quite a different approach where we have 3 federal banking regulators, plus or minus, maybe more than that if you count credit unions and other sort of different types of banks. They have their own federal regulators. So there's at least 3 bank regulators, the Fed, the OCC, and the FDIC. Then you've got 2 federal market regulators, the SEC that regulates securities markets and securities offerings, and the CFTC, which regulates derivatives markets and has anti-fraud authority over spot commodity markets. Then you have 50 state regulators. So you have banking regulators in each state, you have securities regulators in each state, and then you have money regulators, that is regulation of money transmitters, usually like PayPal and Western Union, in each state, except for Montana, which doesn't regulate that particular activity. And then, you have, so what you have at the moment, and I think a lot of how you can explain sort of the state of regulation of crypto assets in the United States is that it is a jurisdictional food fight at the moment between the federal banking regulators amongst themselves, the federal banking regulators with the market regulators, between the market regulators, and then all of those in a bit of a jurisdictional food fight with the states as to who is the appropriate regulator of the activities, crypto asset activities based on the nature of the tokens themselves, but also based on the nature of the underlying activities. Do they look like banking activities? Do they look like markets activities, and why? And then, outside the United States, I think policymakers have been a little bit faster in first classifying assets into different categories, which is less painful because there isn't this jurisdictional fight that drives that classification. And then second, they seem to be more willing to realize that we need legislation because existing laws don't appropriately address either the types of activities, the nature of the assets, or the risks that crypto gives rise to. And so I think in the US, we're still working to get our arms around, what are these things, who should regulate them, and why. I think the events of this last week probably speed up some of those efforts, particularly on the stablecoin front, for the reasons that Scott alluded to. But I think there's still a lot more to come. The fight's being waged in courts at the moment. We can talk about that a little bit. As well as on Capitol Hill, as well as among the regulators themselves. But I'll stop there. I'm sure that was a lot.
No, that was great, Zaid. Thanks for helping us understand really those nuances. I think, as you pointed out, how in the U.S. we have different regulatory bodies, at the federal level, at the state level, and navigating that is all challenging and frankly might require legislative intervention. I think that seems to be maybe a direction we're going. I want to zoom in, though, pretty narrowly on the regulator level. And Zach, I want to come to you on this one. So it seems that most of that discussion seems to center on this notion of whether a digital asset is a security, is it a commodity, and if it's a security, there's this Howey test. Could you just briefly help those not trained in the law sort of understand why we have securities laws to begin with, and how these laws have been tailored over time, or maybe not, as financial innovation takes place? And I think the audience would really benefit from just understanding that role. And since you helped draft securities laws, you're in a great place to describe it.
Yeah, no, thanks. Appreciate that, Josh, and happy to chat about it. So a great way to start the conversation on securities laws is, as you say, to ask, why do we need them? Why can't companies just raise money from whomever they want, whenever they want, without regard to the promises they make in order to obtain money, and without regard to the impact their actions may have on the markets writ large? So, the answer to that is that we used to have a system where capital formation existed in a vacuum of sorts, without regard to promises made or the interests of others, and it didn't work out so well. And at the end of the so-called Roaring 20s, the 1920s, 100 years ago, there was a crisis in confidence in the capital markets, and those markets basically bottomed out. There was massive economic failure in the US that many believe resulted in the Great Depression. And on the back of those failures, Congress passed the federal securities laws, mainly the Securities Act of 1933, which regulates the offer and sale of securities, and the Securities Exchange Act of 1934, which regulates aftermarket trading in securities, and which established the US Securities and Exchange Commission. And they did this in order to bolster investor and market participant confidence in the U.S. capital markets to essentially to bring money from out from underneath the mattress, so to speak, and to get it back into the economy again, so that the economy could get on an upward trend again. And at their core, the securities laws are really about information and accountability for the information provided. That is, the main purpose of the laws was and is to ensure that financial markets are regulated and that investors and markets are provided with reliable information and clear rules to ensure honest dealings and accountability for that information. Now, together, the securities laws help instill the confidence, as I said, in the investment opportunities in the markets, backstopped by liability for fraudulent acts and actors. Now, importantly, the SEC doesn't regulate the merits of a given securities offering. It is agnostic, or it is certainly supposed to be agnostic as to whether something is, quote, a good investment opportunity. It does care about protecting investors and the capital markets generally by facilitating informed investment decisions. Just for background, the SEC has the tripartite mission to protect investors, facilitate capital formation, and to ensure fair, orderly, and efficient markets. They really hew closely to that, and they believe in that very strongly. Over the years, the SEC has picked up additional congressional authority to oversee greater swaths of the capital markets ecosystem, so that they oversee not just securities markets, but also primary participants in those markets, such as broker-dealers, investment companies, investment advisors, private fund advisors, transfer agents, securities exchanges, among others, and also FINRA, which is an SRO that oversees broker-dealers, and the Public Company Accounting Oversight Board, which helps set standards for financial reporting in public companies. Now, the SEC basically implements, they adopt, they enforce, they interpret the securities laws and regulations, and they coordinate, to Commissioner Johnson's point, globally with regulators and also locally on issues of mutual concern. So when we think about digital asset offerings and the potential implications under federal securities laws, we are really talking primarily about the Securities Act of 1933. Now, the issues in the aftermarket with intermediaries may come under different statutes, but with the digital asset offerings themselves, we're really talking about the Securities Act of 1933, as this is the statutory vehicle pursuant to which capital raising happens in the U.S. And in my mind, one of the most fundamental concepts under U.S. securities laws generally flows from the 33 Act, and that is this idea that every offer and sale of a security, even if it's just to one person, must be either registered with the SEC or conducted pursuant to an exemption from registration. This is true whether it's a company doing the selling or an investor in the aftermarket. So every single time you offer or sell a security, you need to either register that offer or conduct it pursuant to an exemption from registration. If you've ever bought a security in the aftermarket, say on the New York Stock Exchange, you may not have realized it, but that was offered and sold pursuant to an exemption from registration. And it's a really important concept, as the rest of the securities laws and the rules under the securities laws really stem from that kind of core principle. And this is why potential implications around digital assets being considered a security is such a crucial part of the analysis and the issues with the digital asset market generally. Because imagine, as you may have seen with, you can sort of visualize with Ripple and with XRP and the claims that it is a security, that the network consequences of having to analyze every transaction in a digital asset on a blockchain, in applications built upon that blockchain, in intermediating transactions in those assets, all of those, if those are securities transactions, then every participant on that network, including a retail person to an application built upon it, to Ripple, the issuer, to platforms hosting and intermediating transactions in those, would need to consider, well, what does that mean for me? What does that mean for my status under the securities laws? Am I somehow now engaged in regulated activity? And what is my exemption? What is, do I have to register this offer and sale? Do I have to be exempt? Or what is my conduct-based regulatory stance? Am I now an exchange? Am I providing investment advice? Am I engaging in broker-dealer conduct? All of these things sort of stem from this idea, all coming from the purported claims that these assets are securities. So, of course, then the threshold question becomes, well, what is a security? And a security is defined under the Securities Act of 1933 and other statutes, kind of in largely the same way, that it is much broader than just traditional stocks and bonds. It includes a wide variety of instruments, including participation in profit sharing agreements or arrangements, notes, and the catch-all statutory term investment contracts, which I'm sure you've heard before. We'll talk about that today. And investment contracts are generally viewed to be a contract or transaction in which a person invests money in a common enterprise and is led to expect profits solely or primarily from the efforts of someone else. Now, the test is often called the Howey test because that's the Supreme Court case that kind of laid out the test initially under at the federal level. And it has been relied upon extensively in enforcement actions to date by the SEC against companies selling digital assets, such as tokens or cryptocurrencies. Now, importantly, with the investment contract test, you need to meet all 4 factors in order for there to be found to be an investment contract. So, if there's no common enterprise, there is no investment contract. If there is no expectation of profits, maybe because it is a consumptive use type asset or product, then there is no investment contract. If there is reliance on the if there is no reliance on the efforts of someone else, then again there's no investment contract. Pure maybe market-based fluctuations in an asset-based value, absent other indicia of reliance, may be sufficient to say that there's no reliance in that context either. So this is where the digital asset space has spent the last 7+ years making their case, as has the SEC in reverse with enforcement actions. And sometimes this analysis is quick and straightforward. Other times it is quite complex. It is always fact specific, and frankly, reasonable minds can differ on the outcome. Lastly, what I'd say is economic realities tend to tell the securities law story the best, and certainly from the regulatory standpoint. And importantly, which is often lost, is that the idea that the 33 Act is really a remedial statute. And so it is generally interpreted to find a remedy to aggrieved parties, so that when somebody is sort of out and feels that they got the rug pulled out from under them, well, and they don't have a remedy, say under contract law, well, they might look to the securities laws, which gives you a broader way to get to potentially be made whole. And that's sort of a big underpinning of why the 33 Act has such broad sweeping applies so broadly, is that it is in fact remedial, and courts look to try to find a remedy to the extent they can. So if you're going to offer and sell a security, you need to focus again on this basic premise: is it registered, or do I have an exemption from registration? Now, registered offerings, they are not practical for most companies, particularly startups. And this is important because you'll often hear Chair Gensler or others speak about that people need to come in and register their securities offerings of digital assets to the extent they're securities. They need to come in and register. And sure, from a process standpoint, that is one way in which companies could come in and do it. But the exempt framework is really set up more for these types of companies. We're talking about startups. We're not talking about Facebook's IPO. We're talking about much smaller companies where registration is not usually, it may be the statutory default, but the market sort of has developed acknowledging that that is not really the best place for new companies to come in, or the framework in which they want to find themselves. So registering the offering, usually not workable. Thankfully, however, the federal securities laws have many different exemptions. There are at least 10, I think. Some of the exemptions are included in the Securities Act itself. Others came in or safe harbors came in and were adopted over the years to address various concerns or different scenarios. Often these exemptions are tailored for issuers based on various factors, including the types of investors that are sought. Are we talking about sophisticated, wealthy people or local retail folks? The manner in which the issuer seeks investors. Are we talking about publicly telling everyone in the world, I'm raising capital through the sale of securities, or are we talking about privately, me talking to my friends and family or close network, people in my personal network? What is the amount of capital that is being sought? Are we talking about a couple 100,000, 5 million, 10 million, 100 million? And then again, the location of the company in proximity to its investors. Am I a local company just trying to raise from people locally, or am I crossing state lines? Am I crossing international borders? All of these things really kind of help inform what are the available exemptions for projects as they're considering raising capital through the sale of securities. Now, in the digital asset space, the main exemptions that folks rely on are really Regulation D, as in dog. That's Rule 506B under Reg D, or 506C under Reg D, both of which really largely get at this idea that you are raising money from accredited investors, sophisticated folks who can absorb a risk of loss, who don't necessarily need the full protections of the securities laws. And separately, the second primary exemption would be Regulation S, as in Sam, and that is for offshore offerings. And you can think of Regulation S as really a jurisdictional safe harbor from the application of U.S. securities laws. I mean, so the idea is like, why would the U.S. care if a company in Singapore is raising capital through the sale of securities from folks in Southeast Asia? They just jurisdictionally, the SEC shouldn't really care too terribly much. So we have a safe harbor that basically says, and even if you're a U.S. company raising from those same folks, the fact that it's happening offshore doesn't really implicate the full breadth of U.S. securities laws protections. There's some uncertainty around it. It's a safe harbor. The claims can be made, but the vast majority of activity in the digital asset space is usually conducted pursuant to Reg D or Reg S. And why do they do that if they're not conceding that these assets are securities, or if they don't want to treat them as securities? Well, they're doing it prophylactically in a lot of ways, because they recognize the reality is the SEC says will likely say these things are securities. And so they want to conduct the offer and sale of these digital assets in compliance with securities laws. And one of the benefits of these exemptions, you don't have to really engage with the SEC staff and have an overt concession that something is a security. So you get the benefit of having a more contractual based agreement that is purportedly compliant, facially compliant with an exemption. At the same time, you don't have to really concede that something is a security, because frankly, it's uncertain as whether or not each given asset would be a security. It's fact and circumstances analysis. So maybe I'll pause there because that was a lot, but that's the securities laws kind of in 10 minutes.
Thanks, Zach. I remember coming to your office and you had on the wall all of the exemptions from the federal securities laws, and it spanned the length of your office at the time. So it's really tough to distinguish 10 minutes, and I thought you did a great job. I want to come back. I want to give Scott a chance to talk, but I want to come back to something you said about the Ripple case and how it pertains to the Howey test, and will that change that? But first, let's focus on this notion of registration. If something's a security or deemed a security, they need to register with the SEC or get an exemption. But much of the blockchain industry's discussion is, put this aside, if it's a security or not, there's challenges with the SEC's current regulatory regime. And so, Scott, I want to ask you on this question. I know Coinbase filed a petition for rulemaking, and so one of the questions that came in is sort of, what are the costs and benefits of regulating cryptocurrencies? So, could you tell us just what are some of the key challenges in applying the SEC's current regulatory regime, and then maybe some costs and benefits of updating it for the crypto space?
Thanks, Josh. And let me just say that I have relied on both Zaid and Zach over the years on legal counsel, and you can see why. They know every little nook and cranny, and I'm just a simple economist. I don't understand all of the rules and regs, but I do understand that if you want to figure out the economics, you have to know what the law says. That's the boundary condition, and that's where all the gravity hangs in markets and for understanding economic implications. And before I answer your question specifically, Josh, I like the questions that have come in through the chat. I think that they're kind of broad and deep, and they kind of lean in this idea of registration. And one of them speaks to what individual characteristics should play a role in regulation in the space. And I would just say, as a very simple economist, when I think about securities laws and the SEC, it's all about resolving asymmetric information. The SEC is a transparency regulator. Crypto assets are inherently different than debt and equity securities. Most tokens today don't offer dividends, they don't pay interest, there is no residual interest in an issuer. And so if you think about securities laws that are designed for initial public offerings by enterprises, they don't specifically work for crypto. That doesn't mean we don't need disclosures for digital assets. It just means we need different disclosures. And I'll also say that another great question came in on the difference between an exchange like Coinbase and Uniswap. The main difference is, are you engaged in custodial services, or is it a DeFi protocol where self-hosted wallets are engaging with each other? If we're talking about custody services, then we need to look for traditional financial regulation to supervise those particular entities. If it's not custodial services, then we're in a whole new world. So when it comes to this idea of registering with the SEC or any authority, I will just say, when you hear comments like the forms are on our website, that's political theater. Anybody who knows crypto understands there is no form. We have spent tens of millions of dollars on outside counsels. If their associates couldn't have found that form, shame on all the law firms that are out there. I worked at the SEC for a decade. I'm not sure what form it is. It's just political theater, but it actually touches on an important point, which is a lot of this activity actually needs to be regulated. And why can't crypto firms just follow the rules? That's what I've been working on for 2 years with Coinbase, first as a consultant, and then I just got addicted to this problem of how do you regulate digital assets, and I joined full-time almost a year ago. But I can confirm today, there is no registration path for digital asset securities, for any digital asset for that matter. We actually, as Josh said, we petitioned the SEC for rulemaking in July. We've responded to our own petition with a comment letter offering advice. We originally said, here are 50 questions that we think need to be answered for anybody to come in to register, let alone Coinbase. And we filed a comment letter saying, here are some ideas on how we could solve these issues. And we may file more comment letters with more ideas. But really, we think there needs to be rulemaking. There needs to be a public engagement and dialogue. This is happening in every jurisdiction around the world except the US. In Europe, we've got MiCA has as a regulatory framework, a market for marketing crypto assets. And we have other jurisdictions, the UK, Hong Kong, Australia, the UAE, Singapore. They've all issued consultations engaging with the market saying, we're going to adopt a regime. Here's what we think. What do you think? And they're all racing to be a crypto hub or the crypto center to capture the digital asset innovation. We haven't done that yet in the US. There are 3 areas where we need to do it. The first is with exchanges. We need to understand, like right now, there is no national securities exchange that can trade digital asset securities. There's no alternative trading system that is registered to trade these securities. Right now, there's no broker dealer who can custody digital assets on a permissionless chain without running a simultaneous transfer agent function alongside of it, which is not how the market works today. Right now, there is no clarity on how to treat the blockchain as a settlement layer. In traditional finance, we bury paper certificates 1,000 feet in the ground, protected by elevators and armed guards, and we figure out this very complicated electronic ledger system that sits on top of it. Today, we can take that to become digitally native. And how do we then adopt clearing agency rules adopted based on principles 100 years ago to the blockchain? These are all unsettled matters that need to be decided by appropriate regulators, including the SEC, before there can actually be a registration of anybody to trade these assets. There's also the issue of digital asset issuers. And I already said most tokens today don't offer interest, they don't pay dividends, they aren't a claim on a residual interest of a company. But they do have characteristics and they trade like stocks. There is information that needs to be disclosed to investors. And if there isn't a registration reporting regime for these digital assets, then it doesn't matter if we have a registration regime for exchanges. There'll be nothing to trade, right? And we haven't seen anything today come from the SEC that would suggest here is a registration path and here is a disclosure that we need on the asset level characteristics of these things that would trade. Now, we've seen some speeches that have come out that said maybe we can follow the asset-backed security regime for disclosures. Special provisions were made for asset-backed securities about the characteristics of the aspects to file, and a regime was built around it. I think the principle of asset level disclosures makes a whole lot of sense as opposed to the issuer level disclosures. But if somebody is going to raise capital by issuing digital assets, it sure looks like an investment contract. And don't you want to know about that team that's building that building that platform, so which maybe some of the typical S1 type disclosures matter. So there needs to be a public discussion on what information should be disclosed, regardless of what the jurisdiction is and who owns this. There are just some very basic level information and discussions that could be had in any sort of framework with the regulators. It could be through advisory committee discussions, it could be through roundtables, it could be through public notice and comment, it could be through a request for information. I could go on and list all the different ways we could have these discussions, but we're not yet having those in the US today, and we should. So Josh, I'm going to pause there.
Okay, now those are great comments, especially I like the parallels with asset-backed securities. I know you and I worked together on mortgage-backed securities coming out of Dodd-Frank, and then the regulation AB, or what we called Reg AB, became Reg AB2, and they tailored it even more for those disclosures. But Zai, I wanted to follow up on a little of what Scott said. And you had made a comment in our discussion the other day that, you know, when you're spending other money, so if we think about a cryptocurrency as maybe currency, and we think of fiat, when you go to spend that fiat, you don't look for a registration or a prospectus or the S1, as Scott alluded to. So what would individuals learn, or why would we need a separate registration set up at the SEC, and what would be in that versus you know, just the white paper or general knowledge that we've seen surrounding all of these tokens?
Yeah, so there's so much to talk about here coming out of Scott's comments. So I think your question is a really important one, Josh, because it gets down to, I'm going to flip it a little bit, right? Scott always likes to ask questions about the legal characteristics and the regulation of different assets. And in turn, I like to ask him about the economic characteristics of assets and how to think about that. And I think, you know, from a lawyer's perspective, right, the right way to start thinking about how crypto should be regulated is to think about its economic function first, right? And I think this is one of the reasons why it's really hard to regulate crypto, because the economic functions sometimes are clear, sometimes are unclear, sometimes are advertised as one thing, but actually are quite a different thing. But taking a really big step back, and Josh, as you said, the company that I'm at is building on the Bitcoin network. So maybe we start with Bitcoin as an example, right? It was meant to be a peer-to-peer, natively electronic currency, a store of value, a medium of exchange, right? And when we transact in something that is money, right? So it's supposed to be like money. And when we exchange money with each other, what do we expect out of that? And I think, to be honest, in the last couple of weeks, the last week in particular, all of Startup America has gotten a very fast lesson in what their money actually is, right? So when I send you a Venmo of $25, I don't expect to send you a prospectus along with my Venmo payment. When I send you a wire transfer or an ACH transfer through my bank, I don't send along a prospectus on the theory that you need to understand what that underlying asset is, right? The whole point of our banking and money regulation is to make sure that we don't typically have to think about what that money is. We just think of it as US dollars, right? It's not US dollars. It is actually unsecured credits against a bank or a money transmitter. But we don't have to think of it as an investment. We're just exchanging value denominated in US dollars, right? So there are some cryptocurrencies that operate like that. And they're, like, you know, maybe they should be just regulated as money. However, the story gets really confused, right? Because to date, Bitcoin hasn't been used as a means of exchange, definitely as a store of value, but not really as a means of exchange. It's instead really been used as an investment. And so the picture is a little bit cloudier, right? Of course, people make US dollar investments as well and think of their bank accounts as an asset. But Bitcoin, you know, a lot of the interest in Bitcoin is based on price go up. And the same is true, I think, across the spectrum for cryptocurrencies. My own view, Scott and Zach can disagree with this, obviously, is that we haven't really seen compelling use cases for cryptocurrencies other than speculative investments. And I think that's why we sort of feel like they should be regulated like securities, because securities too are speculative investments in many cases. And so we have this sort of feeling. There's also we're in a moment right now where you either have securities regulation, which fits in some ways, doesn't fit in a lot of ways, or you have no market regulation of cryptocurrency activities. And that doesn't really feel right either. And so I think we're at the moment just facing a bunch of gaps, but I think the important thing is to think about what the economic purpose of the instruments really is, and then what the activities involving the instruments are, the crypto assets are, and then what regulation is appropriate and relevant to protect consumers, to protect financial stability, and the rest. I think the same kind of question is really relevant for stablecoins, right? There's the bank regulatory model where the public doesn't know what assets the bank is holding, right? That's for the regulators, versus a stablecoin model or a money market fund model where there's public disclosure really often about what the assets are. So, we can think about different models of regulation in terms of what's appropriate for different assets. But there's a lot more to unpack in Scott's comments as well, but I'll pause there.
Yeah, I actually want to come to Zach. Those are great comments. And Zach, one of the things that you mentioned, it's similar to one of the comments that came in. We need an agency that has this sort of understanding, a really deep understanding of crypto. And Scott, I remember talking to you a year ago when you had just joined Coinbase, and you told me that every day you were learning something new. It was, an incredible learning curve. And I think anybody, and including the researchers that are on this seminar, know that that's difficult. So Zach, could you tell us a couple of things about, like, how does a regulator like the SEC, when they're trying to determine if something is a security or not, or to trying to determine rulemaking? We certainly haven't seen what Scott alluded to, which is the traditional path of comment. You propose a rule, you receive public feedback in the comments, and then you decide whether or not to finalize it. Instead, we've seen sort of what industry is called regulation by enforcement, which is just to regulate enforce every single token that's issued that they believe is a security. So could you answer what expertise it would take for the commission? Are they going to need to win every single one of these litigation actions that they have brought? Or you mentioned earlier the XRP Ripple case. Is that going to maybe set a precedent? Is that going to define something new other than how we test digital asset space?
Yeah, sure. I mean, so to the SEC's credit, they have not rushed out guidance. So there comes a time when guidance is needed, and we're probably there or past there, but they didn't rush out guidance in 2015, 2016, 2017, when they were really encountering these things for the first time. They did what they should have done, which is to not put out anything that's super prescriptive until they have a good understanding of what the technology is, because that's the last thing you want to do is come out with something that is going to be outdated, by the time it makes it through to adopting release, that it's sort of already useless or already needs to be updated. And so having guidance come out from the commission at the commission level for, say, a rulemaking is not something that you would have seen or wanted to see in the first 5 years of their kind of facing these issues. But their ability, this has been going, they've been in this space for 10 years plus now. Their ability to understand the issues and to come out with principles-based guidance, we're there. We're certainly there if not already past there. The Coinbase's petition is a great example of people spelling out what types of information, how this world could look. People have obviously been into the SEC and talked to them about that. They've learned a lot through the enforcement actions, but do we need greater expertise there? I don't know, to be honest. I don't know the answer to that. I would think you can always have greater expertise. I'm learning every day. I've been working in this space almost exclusively for 5+ years now, and I still learn about new projects, new things that people are doing, all of which, going back to what I said before, in the facts and circumstances analysis, could change the whole thing. And so it is, it's a taxing exercise. It's a really taxing space. You should see when I turn my camera off, you should see my picture when I started at Ketsal. Now you can see my gray hair. It's sort of like the presidency. Operating in crypto is very intense. It's they say like a year in crypto is like 5 years anywhere else, and it really is true because there's so much to navigate. And so, I have empathy for the commission in not wanting to kind of foot fault and get something out that is immediately useless. No commissioner, no chair ever wants to be in that position. But the need for guidance of some sort, not prescriptive, principles-based in all likelihood, that acknowledges the sort of various principles and flexibility around projects. They can certainly do. They 100% have the expertise for that, and they've done that a number of times, as you said before, with Reg AB and other regimes. A smaller company capital formation where you have tiered disclosure type things. They're set up for this, and they can do that work if there's a willingness to do it. The enforcement actions only get you so far, as I said at the outset. It's a temporal fix. It's a thing that enforcement is a tool that lasts forever, but as a way to kind of help delineate a market and the general principles, they've already done that. Like there's only so much you can say. How many more times are they going to say this thing this token is a security? People are not getting the message, and so they need to do something different. And the way that you do something different is use your exemptive authority, which they have, to come out with rules that accommodate and acknowledge the nuances of the digital asset space. Appreciating, as Zai said, that this is not a monolith. I mean, every asset is different, and so I'm not saying everything could come in under a given regime, but certainly investment contracts, it seems as a concept, could come in under a regime. And what is the impact of Ripple? I mean, to be honest with you, it's sort of like that's almost in the crypto space. That's like yesterday's news. It's sort of, I don't even know, frankly. I mean, I don't know what'll come if there's something happens with Ripple that says it's a security. I mean, this space, what I think the regulators continue to fail to recognize is the people building the space are so adaptive and nimble that they just, whatever happens, it's not going to be fatal. They'll just go offshore, they'll do it somewhere else. And so having a regime that is accommodating and encouraging people to come in and provide the disclosure that Scott said is really important, because otherwise it's just going to be whack-a-mole for the next 10 years, and it's not going to, you're not going to have any sort of robust adoption or progress, because people are spending so much much effort in avoidance, as opposed to just embracing disclosure and coming into a regime that will work for them ultimately and work for everyone who wants to participate on these networks.
Josh, can I jump in to build on something that Zach said? Because I think it's really, really important. It's really amazing, I think, that everybody now knows, SEC versus WJ Howie's obscure case about oranges and other things. Like Howie is now a household crypto name. But we need to really think about what the purpose of the Howie case and the term investment contract was. The term investment contract is, as Zach said, included in the long list of instruments that are securities under the securities laws as a catch-all, right? It was always intended and always applied before crypto as an ex post remedial tool to allow plaintiffs to get the benefits of security law remediation in circumstances where they had purchased an instrument that was a security but wasn't sold as a security initially. It was never meant to be a tool that people design towards, right? You're not supposed to design an instrument to be an investment contract. Like that's not ever how either the term investment contract was meant to be applied, or in fact, how courts have applied it. And so you can see this playing out a little bit in the litigation so far, where, to be honest, the SEC, and Ripple is a really good example, has itself been a little bit discombobulated in how it's applied the investment contract and to what it's applied the investment contract. Sometimes the SEC says digital assets themselves are investment contracts. Sometimes they say that digital assets are sold as part of investment contracts. Sometimes they say that there was an investment contract in which a digital asset was involved. And you can't actually fit the investment contract principles onto a digital asset, nor should you, because we know what crypto assets are now. You don't need the ex post tool. What you need is clear guidance on how people can ex ante. See, Scott, I'm using economist terms, ex ante design an instrument, just like you do for any other type of financial instrument, from the beginning, either to be a security or not be a security, and have legal certainty about its classification through its entire life, right? And I think that one of the big issues that we're facing, and what Zach is alluding to, sorry, is that we don't have that certainty, right? Right now, the guidance that the SEC has issued about when digital assets are securities or not depend on like 50 factors. You don't really know which way those factors go. They're based on information that could be publicly available, but also information not available publicly to market participants. And that's just like, at some point, a test is not a test if you can't reasonably apply it in a repeatable way. And I think that is exactly where we are with trying to figure out whether digital assets are securities or not. In my own view, digital assets themselves are rarely securities, to be honest, including digital assets like XRP, but they've often been offered in securities offerings, just like the investment contract in Howie was the sale of a promise to develop citrus groves and sell the oranges and share profits, not the oranges or the citrus groves themselves. And I think we've just gone down a kind of crazy Howie rabbit hole that just, to be honest, needs to be fixed by Congress.
Zaid, can I respond? Josh, am I allowed to respond?
Yes, please do.
Yeah, like there is no secondary market for investment contracts.
Right.
Like they don't exist, they never will exist. And I like your phrase, the heuristic in my mind is the oranges aren't securities, how they offered were. And what we need is rules to how to trade the oranges, which are different entirely from the investment contract. And that's just been completely lost in all of the discussion of the litigation. And going back to Zach, something you said, how you said, well, it's not going to be fatal to digital assets if we don't get clarity in the US. I just want to make clear, it could be fatal to the US as a digital asset innovation hub if there's not clarity in the US, because every other jurisdiction is racing to offer the regulatory environment to make this happen. Make no mistake, the EU promulgated their rules to be the epicenter of digital asset innovation. The UK is going to try to one-up them to have London be the epicenter. Hong Kong, Singapore, the UAE, they're all trying to do the same thing, and they're way ahead of us. Doesn't mean we can't catch up. Like all the stuff we've offshored, and we've offshored a lot, 10% of the global volumes in the US, which is like about 70% less than anything else by GDP. It'll come back if we establish the right infrastructure and rules to do that. But there's Josh, there's one question that came in, I think is super important, is like, what is crypto actually good for? Like, this is a really hard question to answer. Zaid focused on this. He's like, frankly, what we don't have are good use cases. And the reason why is what we've done is we've built the plumbing. All the technicians have come in and said, here's the platform to do great things. In classes that I used to teach, I would show the interview between Bill Gates trying to explain to David Letterman in 1995 how great the internet is. And the examples he used were stupid. Well, you could listen to a baseball broadcast on the internet, and David Letterman said, have you heard of the radio? He's like, well, yeah, but you don't have to watch it live. You can watch it after the fact. He said, have you heard of a tape recorder? And so you could see like Bill Gates trying to explain how great the internet was and was going to be, but he had no idea that one day there'd be immense joy to tripping over boxes when you opened your door because Amazon came. Like, he just couldn't figure that out, but he knew it was going to be great. And that's where we are today. So what you see today, they're proofs of concept that could be big, but you're not going to get Amazon accepting Bitcoin as a means of payment if there's not regulatory clarity about how this stuff works. If the regulatory clarity comes, the use cases will flourish. You'll start having tokenized United Airline miles that you can trade for American miles, perhaps one idea, but there could be thousands and thousands of things that you can do because you can tokenize anything now, divide up ownership and trade on a platform. So that's my little grievance with what is the true value of crypto today.
Well, let's stick with that for just a second, Scott. A comment came in from Joe that said, I started my business degree in the early 70s. None of the financial tools I learned then help me value crypto now. I've taught an introductory finance class. You have to. We all know that, you can supposedly value any asset in the world if you know the level, the timing, and the risk of the cash flows. That's what we teach MBAs. At a class yesterday, we were talking about using a discounted cash flow model. What data do we need to value cryptocurrencies? And I know it's going to differ based on the use maybe of the cryptocurrency or the digital token. What data is useful, and where can we get that data?
I'll take a first stab at this. I would say the answer is the same thing as an employee at Coinbase. I look at the stock price to figure out how much we're worth. I have no idea until I look at the stock price, and then I know the market gave me an answer. How they came up with that answer, I have no idea, but that is absolutely the best guess of what Coinbase is worth today, because it will impound all sorts of information in ways that we can't figure out. In digital assets, if you see the price of tokens, that is the best guess to what those tokens are worth. And a lot of times those prices are anticipating what their future functionality may be, even if it doesn't exist today. So that is absolutely like the best place to go. And exchanges publish that data, and there could be rules that could make that data more accessible, and that would lace together information across exchanges like the MBBO that exists in traditional financial markets. So if you want to know about the valuation, the market price is always the best. There's also another tool you can use, and frankly, I don't know how to use it very well. That's on-chain information. You can see all sorts of stuff about assets that are on-chain. Like when Terra Luna blew up, we knew exactly how big that market for that coin was at every particular point in time, because that data was all on-chain. Now, it's complicated to use chain data, and you have to become experts in it. And frankly, I feel like my time has passed to be that expert, but if you're an enterprising PhD student out there, what a great use of time.
Josh, can I jump in? Sorry, Zach, you should also obviously jump in if you want. Look, of course, Scott is right. If you want to know the value of something, look at the market, fine, right? But to me, this is just like another indication of how we've gone kind of wacky with crypto, right? If on the one hand, we're saying these tools are meant, crypto assets are meant for some particular purpose and for utility. And then on the other, we're like, oh, just look at the effective stock market in these tokens for their value, right? These tokens don't have fundamentals the way equity or debt does issued by a company, because there isn't a company that's issued them, right? So I think that the real answer is it's not altogether obvious that the market price of the token is actually how much a token is inherently worth. We like to think that the stock market works better that way, but I call into question the real utility of the market prices. I think Scott knows exactly where I'm going with this. One of my co-founders, Kristin Catalini, wrote a piece in the HBR online edition asking the questions, why should we care about crypto prices? Maybe we shouldn't. We're really not measuring the value of crypto accurately. We shouldn't be focused on things like horsepower for cars, because that doesn't make any sense anymore. Similarly, we need to really think about what the value of crypto is based on the use cases, which of course gets us back to there really need to be use cases which develop in the markets, which in turn relies on some regulatory certainty, because responsible corporate actors are not going to jump into a space that's so fraught with regulatory uncertainty. Lightspark is building on Bitcoin because there is more certainty in how Bitcoin is regulated than any other asset. Like this seems the tail wagging the dog in some senses for the crypto economy overall.
Yeah, I mean, on the price bit, I'm slightly more jaded on price, only because I see I work with a lot of projects, and I see how they have to, what happens to price when they launch, and the potential that there's manipulation behind it through third parties. There's a lot that goes on with digital assets that, again, all the more reason why we should have a regime that people can embrace, and so these things can get sorted out. But there is a lot of certainly on the narrow issue of price. I'm very skeptical of any price I see anywhere, just given what I see happening on the back end. And then on data points, to Scott's point, the block explorers are great. They can give you so much information. You can watch the transactions in real time. You can go out to wallets, see you don't necessarily know, they're pseudo-anonymous. You don't know whose wallet it is, but you can see transactions across wallets, and they have wonderful tools from an investigative standpoint that can be used in any number of different ways, which can show flows of funds across and track things. Really remarkable in what they can do in real time, and that people willingly do that, and that the irony is people willingly do that and then commit fraud or try to manipulate, and then it's all there for everyone to see, which is a powerful thing that's often lost. And to sort of to the points raised earlier about Terra, you could see it in real time, and to the extent that somebody was trying to hide, you can only hide so far, because eventually it's going to be parked in a wallet that you're probably sitting in control of, and somebody will eventually make their way out to that transaction. So the data is there. I like to say that one of the power of the blockchain, and one of the great things that people don't really talk about, I think, Scott, you kind of alluded to it earlier, which is that it's sort of like, if there was a headline for it, it would be the paperwork crisis averted 50 years too late, because the whole point is the ability to keep the records safe, and we have a whole financial system set up that was set up to dematerialize stock certificates to make the trading efficient across markets. And then we have a whole bunch of intermediaries on the security side who are who've come into play and been created on the regulatory level in order to address potential moral hazard across these various parties. And then you have blockchain, which basically, at its best, I'm not saying we're there yet, but at its best could sort of obviate a lot of those functions. And there's people aren't really, recognizing that, because they're focused on some of the, the distractions, the sort of the noise in the space, rather than really at core what's really valuable, which again, I think, if you look back and read some of these old SEC releases on transfer agents and that sort of thing, this whole regime is, took 40 years to set up, and then blockchain comes along and in many ways has challenged the whole thing. And I think that is unsettling for any number of players who that's their whole business model. And for regulators who stake their whole career on writing those rules and enforcing them. So there's a bit of need to move people off of their perch, so to speak, and to encourage them to come down and see what's actually here and the value in it. But that's still TBD, right?
Definitely, and I'll jump in and add something quickly. Scott, you mentioned, if you want to know the value of Coinbase, you can just look at the stock price. The market gives us a good answer. That's, of course, grounded in semi-strong form market efficiency, and that is that we have enough disclosure such that you can accurately price the risk. So I think this sort of speaks to Coinbase's petition for rulemaking and wanting to provide more disclosure and sort of tailored towards the digital asset space. A question came in: when you think about crypto at the asset versus entity level, who needs to register? Is it, if there's a DAO, does the DAO need to register? Do we register every token? What's sort of some of the nuances on that? And it's really open to any of the three of you to jump in.
Yeah, well, I have views on that. So there's a statutory term, right? The issuer under the Securities Act, and that is whoever falls within that bucket is the one who's supposed to be registering the offering of securities. But it is we have the sort of industry has been set up to where that is not entirely clear who would be the issuer, who is the party responsible for the security coming out and into the market. Is it an entity wrapped offshore that is simply doing the ministerial functions of minting the tokens and getting them out into the world? Is it the party that sits above that entity, perhaps an ownerless offshore foundation? Is it the development shop here in the States or abroad that essentially created the code and contributed to those third parties? Where in the mix is the issuer for these securities laws purposes? And I think Reg AB is a good example of the SEC grappling with that issue and coming out with a framework to say, we recognize there are various parties here. We need you all to come together and give us the information we need. Doesn't really, we'll consider you all the statutory issuer, or actually it's one particular party, the statutory issuer, but that's the kind of guidance that there's not really in this space. And so folks don't really know when you have a decentralized organization, like MakerDAO, how would you get thousands of wallet holders to come together to register? That would never happen. So the concept of when there's an issuer, there's certainly, like, it's one of these things where early days, there's probably an issuer, right? There's probably an identifiable issuer early days, but as something progresses over time and the holdings diminish, then that question of who the issuer is should change, because the idea that somebody has asymmetrical information about a project is not really there anymore.
And to follow on that, Zach, as you become decentralized and the issuer is less clear, and there's a market maker or a broker dealer in some future state where you could register as one that's making available to trade these assets, what is the regime that would get that asset level disclosure to the market so they can make those decisions? That's a question that just popped up into the Q&A. I think it's a very prescient question, because there needs to be that regime, and there are lots of ideas. Coinbase has surfaced them, so have others, that needs to be addressed in order for markets to be able to more accurately price information.
Awesome. All right. We have a hard stop in 3 minutes. I want to ask just one last question. The chair of the CFTC was quoted in Politico this morning saying anything is better than nothing when it comes to crypto legislation, and said we shouldn't let the perfect be the enemy of the good. What should be legislated here? If the regulators can't figure it out, if there's a continued turf war, what's the lowest hanging fruit?
Oh, like red meat in the zoo. I don't know. Okay, so 1, stable coins, 2, regulation of market intermediaries, 3, delineation of what's a security and not a security, and then disclosure regimes for offerings of each. Easy. That's the problem.
I'm in favor of any regulation that brings clarity to the market and compels regulators to use their authority or gives them authority. There's been lots of good discussion and legislation been worked on for the past year, and I'd like to see any of it continue.
Yeah, nothing to add to either of those. That was like Zai's response is sort of encapsulated what I would have thought of had I been able to.
Perfect. No, I also thought stablecoins was, actually after the original Biden memo, I thought stablecoins would have been legislated, at least to verify the reserves last year. And we see the dangers of perhaps not knowing what those reserves are or where they're held, even in traditional finance, held in actual banks. So I would agree on that front too. So we've got 2 minutes left. So we have one more question that's come in. I'm still curious a little about the underlying technology of the crypto ecosystem, which is decentralized or is it centralized? It's handled by crypto whales who can manipulate it. In 1 minute, can you encapsulate? I know this is probably impossible. Or where could we go to learn more about such technologies that underlie crypto?
I defer to the founder of Lightspark on that one.
Where can you go to learn about it? Look, I mean, so the comment is correct, right? Just like in other financial markets, we have issues of market manipulation, of insiders trading, of large holders trading. To me, this is not all that different than securities markets, derivatives markets, other financial markets, and thus the need to regulate them, the need to regulate crypto asset markets accordingly. In terms of where you can go to read about crypto, I mean, it's the internet. There's so much written, everything from law journals to tons of economics papers. Actually, the Federal Reserve banks are putting out a lot of papers on different aspects of crypto asset and crypto asset markets. I find them to be really good. The international organizations are doing the same, like the FSB, the BIS, the ECB, the IMF. Should I keep going on alphabet soup? But there's just so much information out there. I think a source, a sort of curated source for good crypto literature would be a good idea. I haven't really seen that out there, but it's an idea.
Awesome. Well, a fantastic response, and I know we're up against our stop. So I want to, on behalf of everybody at the CBR and everybody in the audience, thank our panel for really spirited discussion and having so many different views and trying to just help us understand regulatory terms and legislation and the technology behind all this. And so I know all 3 of you are very busy, and so we sincerely appreciate you taking the time to share your wisdom with us. And I'm sure you'll get asked to do it again now that this is out there for participants. So thanks so much, and thank you all in the audience as well for participating.
Thanks.
Thanks, Josh.
All right.
Zay.
Thank you.
Thank you all.